economy in Canada is not that strong already anyway. I think several people have pointed out that if you adjust for the population growth, which has been, if you count temporary residents, it's been pretty spectacularly, it's up over the 2% annual rate. We haven't really had any GDP growth. We've been in a GDP per capita recession for a couple of years now. So
where are we in the Canadian housing market crash? I have with me Hilliard Macbeth, who wrote an amazing book on the housing market crash in Canada. We're going to be getting into where we are in the crash and many other things in this interview. Hilliard, it's an honor to have you back with us. How are you doing today?
I'm doing wonderful, and it's great to be talking to you again. It's been a little while, I guess a year or two, but lots has happened in the in the Canadian housing market since then. It's just amazing.
It is, yeah, it is. And I'd like to kick it off really with, you've probably seen it a million times, Hilliard, and I'll bring it up on screen. Hopefully you can see this as well. Basically, it's just this chart where you've got the bubble cycle essentially. And I'm just kind of wondering, in your mind, because you've investigated not just the Canadian bubble, but many bubbles within your book, whereabouts do you think we are? Do you think we're in that denial, return to normal phase, or do you think we're more heading towards that fear phase now, or do you think we're somewhere else even?
Yeah, I think we're still in the denial. I mean, there's a lot of talk about the rate cuts happening soon, and there's still a very large, probably the majority of the people. I saw one of the reports saying that I think it was more than 60% of the people believe next year will be a good time to buy a house. So obviously they're holding off till the spring, let's say, to wait for interest rates to come down, but they're not really factoring in the possibility that prices could drop further. So prices have already dropped, especially in Toronto, not so much in Vancouver, but in Toronto, there's some bargains starting to show up, but especially in the condo market. But really, if a 500 square foot condo was selling for $750,000, now it's selling for $650,000, that's not the kind of bargain that you get in the fear stage. So it seems like we're not quite in the fear stage yet. And I know you have that other chart that I do every month that you can see. It's actually kind of interesting because the little squiggle in that you can see the little squiggles there. You can see it basically goes back to 2022 when the three markets. We've got Toronto, Vancouver, and then we've got the Canadian market in the dotted line in the middle. So Vancouver is the one that's held up the best. It dipped and then it's rallied, and it's dipped and rallied. Toronto is actually, in some parts of Toronto, substantially lower than it was in 2022. So it looks like 2022 is going to turn out to be the peak, and so we're 2 years into this, which it's understandable. Some people might think that that's enough, right? 2 years is a long time, but we're really, a big part of my thesis was there would be a bursting of the bubble, and the bursting of the bubble is not just a small dip like that. When you look at the bottom of that chart, you've got inflation, and you've got income from wages, after-tax income from wages, and you've got the CPI and the shelter index. So for that gap from the four lines at the top and the three lines at the bottom, the gap is huge. So a true bursting of the bubble would bring it down to maybe where, just to pick a number, 250 to 350 in that range there on that chart. There's a big white space beside it. That would imply, let's say 300, halfway between those two. That would imply, house prices had gone up threefold in 25 years. So that's still a phenomenal rate of growth. It's just not quite the rate of growth that we've seen, but it would still be a pretty substantial rate of growth, and it still would be higher than inflation and higher than income. So we got a long way to go if the true deflating of a bubble actually happens. And the thing is with deflating of bubbles, which people, because it's been so long since we had a deflating of the bubble, is they generally tend to deflate all the way back to the trend line that was in place before the bubble formed. So that would, in this chart you're showing now, would indicate that dotted line there. And this is a generic thing. It doesn't have anything to do with Canada or the US. There's obviously some estimates in that. But Grantham is the genius of bubbles, I think, and he said that they all deflate back to the trend line that was in place before I forget how many. He studied 30 bubbles, I think. Now he was talking the stock market, not the housing. So I'm the one that took it from the stock market to housing. He didn't check the housing bubbles, and they may be different a little bit, but in the stock market, he said that all of the 30-something bubbles that he discovered, they deflated all the way back to the trend line. And he said most of them actually go well beyond the trend line. In other words, they go well below the trend line in the deflating of the bubble. So and that we're talking about the Canadian housing bubble today, but we could also talk about the U.S. stock market and the S&P 500, because it would be the same situation where there's a bubble there. And Grantham recently has indicated that he believes that will deflate as well. So that'll be, he says, it'll be in the stock market. It'll be the equivalent of the 1929 or the 1999-2000 deflations, which were pretty severe. The obviously everybody knows 1929. Most people know the 2000. We were talking 70-80% decline. So 20% to truly deflate the Canadian housing bubble to get back to housing is not enough. It would just be a pause in an upward trend. If the prices started to return upwards again, which I think is what the majority of the people believe now, at some point they might go a little bit lower, then that wouldn't be the end of the bubble. That would just be a continuation of the bubble. And we've had that. We had it in when the home capital crisis exploded. We had it, and then that was in 2017, I believe, and then in 2020 when the COVID epidemic hit, we had another situation, and both times outside forces jumped in with some money to prop the market up and keep it going. But this time it seems like maybe that won't be possible. There isn't a lot of room left to, even with cutting interest rates very rapidly. I have a feeling that it won't be enough to keep the bubble going this time.
Yeah, because even the debt, I think I read on Better Dwelling last week, is mortgage debt outstanding is something like $2.3 trillion, which, that's bigger than even the government can handle. And it's kind of crazy to even think about that number, but it's just absolutely massive. And do you think that one of the signs maybe where we get, and I'm just really throwing this out there, do you think one of the signs would be like mortgage debt, when mortgage debt actually starts to, because it's been growing at such a rapid rate, eventually you would expect when the bubble really starts to deleverage that mortgage debt would start coming down as well, as more and more bad loans get uncovered? Or do you expect that to kind of continue growing regardless of the fact?
Yeah, no, I think the mortgage debt would start to shrink, and that's a very, very difficult thing. So we're talking about a recession now. So if you get a situation where mortgage debt, so that chart that we looked at, we didn't mention that red line that was in the middle of those three housing lines at the top of the chart. That's the debt, the household debt. So household debt is that red line, and you can see it's 5.5 times what it was in 2000. So that's, that growth rate is well over 10% annually, and that is a pretty amazing number when you think about that. So that is household debt. So that includes actually mortgage debt, which is about 80% of it, and then HELOCs and credit cards and car loans and just unsecured line of credit. Just all that stuff. So, and it's a little bit behind, like it's, I think that those numbers are, the housing price numbers are almost like only about 3 months old on average, but the household debt number is probably more like 6 to 9 months old. It takes a while to get reported. But so when that rolls over, it starts declining, and it never really, for the longest time, it hasn't declined. The last time it declined was probably in the 1990s. And it would be a very severe downshift in the economy, because the economy in Canada is not that strong already anyway. I think several people have pointed out that.
This video was powered by ExpressVPN, helping you protect your privacy with the world's fastest VPN and the VPN that I use. If you want to take advantage of my special offer, go to expressvpn.com/marketmania. Let's get back to it.
The economy in Canada is not that strong already anyway. I think several people have pointed out that if you adjust for the population growth, which has been, if you count temporary residents, it's been pretty spectacularly, it's up over the 2% annual rate. We haven't really had any GDP growth. We've been in a GDP per capita recession for a couple of years now. So for mortgage debt to start shrinking, that takes a lot of demand out of the economy. Because if we need to, at this point, I think, point out how important debt is to to our economy. And I started out as before I became a stockbroker and then a portfolio manager and an analyst and an author. I started out in graduate school in economics, and I'm a dropout. So I was working on my master's, working towards, thinking about going to PhD at Queen's University and in Ontario. And but what I discovered was that I loved the math, but what really bothered me was that there was very little connection between what the economists were looking at and doing all these fancy mathematical analysis of and the actual real world economy. And it was totally theoretical. There was no practical into it. So I decided to drop out and became a stockbroker. So there are a couple of, keep the story short. So and certainly the stockbroker world is very real and very gritty, and it was completely different from an academic career. So but one of the neat things that's happened in the last 10 years is with writing the book is I met a guy named Steve Keen, and he's got a book called Debunking Economics. And you may have run into him, I don't know, but he pointed out all the flaws in the mainstream economic system, which basically are all the things that bothered me about it when I was in graduate school. I didn't really understand the full story, but Steve Keen has laid it out in several books, actually. And one of the key things that relates to what we're talking about in housing is economists completely ignore money, debt, and banking. So money, debt, and banking are the most important things to the economy, pretty much, in terms of making it go. And so if you take the influence of debt, for instance, that red line we saw out of the GDP and out of the economy, economists are looking at a very, very limited understanding of what's going on in the economy. What they assume is that banking takes money in from depositors and then lends it out to borrowers, and they act as an intermediary. And people in the Federal Reserve, as recently as Janet Yellen, indicated from their public statements they still believe that this is the way it works. And this is totally wrong. It's not the way it works. And it's been pointed out by the Bank of England and Steve Keen and a bunch of people that that's not correct, including me in my books. And so without that ability to create money from the banking system, the slowdown in the economy, and Steve Keen calls it credit, which is the annual increase in the amount of debt in the system, the slowdown in buying power in the economy is dramatic. And it leads to a very severe recession. So we have not tested this. So we came very close to testing it in 2020 when obviously the private sector stopped borrowing money, stopped spending money because they were at home. A lot of them were out of work. They couldn't really go to the bank and get a loan anyway. So what the government of Canada did, and all the governments in the world pretty much did, was they stepped in and in the Canadian case, I know the numbers, it was about a $500 billion deficit. So a huge deficit in Canada prior to that was 20 or 30 billion, and they made it more than 15 times as great and stepped in and did that. So that money was there to make up for the lack of spending by the private sector. But it had the really interesting and unfortunate side effect that people took that money because basically the government spent the money into the economy, just like a bank creates money when it makes a loan. And they took that money that they got and they went and bought housing with it, which is, I'm sure, shocked the people in the government. It certainly shocked me. I was that's where you got that peak on that chart we saw in 2022. That was the impetus there. People took their money from the government, their COVID money, and look at the way those lines shot up there, and including the debt line as well. So the debt line had been growing along there, 7%, and now it's maybe a little bit more per year, and then it started to go up at maybe more like 9 or 10% per year. And that's pretty amazing when you consider that there were quite a few people that were out of work during 2020. So they managed to get their hands on the money. It was money that was spent into the economy by the government. And then, of course, the banks, and I don't have any way of knowing this for sure, but my guess is that the banks were told to be cooperative in terms of facilitating purchases. So, for instance, one of the stories was that people in Toronto were cooped up on their little 500 square foot condos, and they bought houses in Peterborough or places like that, or Oshawa for $1 million without even seeing the house. Now we know that they didn't have time to sell. There was no way to sell their property in Toronto. So it was an additional purchase on top of what they already owned. It seems very unlikely that they would have qualified for those loans without some kind of a easing of the financial conditions that the banks usually present to borrowers that are buying a second or third home. So. And that, those prices in Oshawa, for instance, have come down quite a bit more than the 20% that single-family homes have dropped in Toronto. So, but getting back to the mortgage, because we started talking about mortgage debt, and this all links together. So when the bank issues and most of the people that are listening to this have experienced this. They go to the bank, they sign the forms, and I remember the first time I did it was probably 1980 or 81 or something. It was quite shocking to think that the next minute all this money appears in your bank account. Now, you can't just take that money. They don't let you just take it and spend it on anything. It has to go into the house purchase that you've agreed to make as part of getting the mortgage loan. So it leaves, in most cases, it would leave your bank deposit. It's created into your bank account as a deposit, and then it immediately goes to maybe another bank. It becomes a deposit in another bank, and then it goes to the seller of the house, which would then deposits in their bank account. But before you signed those papers, that money did not exist, and people question this. There's, as I mentioned, there's Federal Reserve economists that still believe that money came from somebody's account, savings account. Yeah. Was lent out to the new home purchaser. But the problem with that is that when you try and go and examine, well, whose account actually dropped by, say the loan was, maybe it was a $900,000 loan to buy a house in Toronto. Whose account dropped by $900,000 in order for that loan to be created? $900,000. It doesn't happen. So it's new money. And so we know that that's the case. The Bank of England did studies of it, and other economists have done studies of it. And but the other way we can prove that it is new money, beyond just the idea of taking the money from the savings account and lending it out to the borrower, is that red line on that chart that we were looking at could not have grown faster than the lines at the bottom. So the lines at the bottom are a rough proxy for the economy, the GDP. So we've got after-tax income, we've got the CPI. Generally, that's roughly the pace of things. And for the debt on the red line up there at the top to be moving up that fast, the savings accounts would have to be dropping by that same amount. And that would mean that there would be a tremendous headwind on consumer spending, and it would be very hard on the GDP. So you'd have to create that amount of savings in the economy to do this, the system that unfortunately mainstream economics is still using as their model for how debt actually works. So the rapid pace of growth in that red line on that chart is a signal or a proof that banks can actually create money by making loans. And now it doesn't apply to non-banks. So non-bank lenders actually have to, there's all these shadow banks. About a lot in the last little while in Canada that were making the loans that other banks refuse to make. And they do need to actually raise the money from investors in order to have the money to, because they don't have access to the central bank's system that allows the charter banks to create money when they make loans. So the other source of money in the economy we alluded to already is the ability of the government to run deficit financing. So they can very much create money into the system by spending the money into the system, because they don't actually have to. This is another myth in the economy that is widely thought of but misunderstood, is that the government has to raise taxes in order to have money to spend. And that is not the way it works. The way it works is the government first spends the money, and then they have the ability to create that money in the act of spending it into the economy. Then they can decide if they're going to tax some of that money back or all of that money back. And this is quite likely. I mean, there'll be studies done for a decade or two about what happened during COVID. It's quite likely that the fact that they spent all that money into the economy during COVID and then failed to tax most of it back was the cause of the inflation that we saw afterwards. But now we're at the point that stimulus from the COVID is wearing off. Obviously, it's mostly off, I think, and the incredible increase in household debt, especially the private sector debt, but especially the household debt, is also wearing off. The rate of growth is slowing down, even though it doesn't show up in that red line. The red line, as I mentioned, is out of date. The latest numbers we see have the mortgage debts in Canada declining, or at least not growing as fast as the economy. So those two headwinds are going to be pretty severe. And so it would be normal to get a recession at this point in the cycle. The recession will be the thing, I think, that causes the bubble to finally burst. It's been a long time coming, much longer than I thought it was going to be, obviously. But we still think that the bubble will burst. And what can the government do to hold prices up during a recession? It'll be interesting. The government of Canada will be scrambling, and the options are limited, I think.
I've kind of pondered the idea. I mean, I don't know whether it's going to be the case, but I've kind of thought that regardless of who gets in, it looks likely it's going to be the Conservatives after Trudeau's track record and everything that's happened. But whoever is in power at that time, it looks likely to me that they'll go down that same stimulus road that they went down in 2020, and they'll kind of say, oh, this was a great success, even though 2 years later, massive inflation, huge economic distortions, obviously. And then I've also kind of thought, well, is that even gonna resolve the issue? Because in 2020 it was unique because the supply chains were disrupted, people weren't making stuff, like the economy was mostly shut down when that money was put into the system. And it's an interesting, I don't really know what's gonna happen. It's going to be really interesting to see.
It's hard to imagine them spending $500 billion into the economy like they did, and it just isn't going to happen. And most likely there'll be an election. Most likely, almost for sure, the Conservative Party will take over, and they'll. They always talk about balancing the budget. The last Conservative Party we had was Stephen Harper's government, and they always talked about balancing the budget, though they never quite accomplished it. But they talk about it all the time. So they actually were the ones, just a little history note, they were actually the ones that first brought in zero down payments and 40-year. A lot of people today think this 40-year or infinite mortgage amortization thing is new, but it was done as recently as 2008 by Harper, and Flaherty was the finance minister at the time. That they were using the housing market to stimulate the economy, and it worked. Like in 2008, 2009, Canada had a much less severe recession than the U.S. because the U.S. was dealing with all these collapses of the housing market and of the lenders that lent to them and all the people that speculated in the housing market. And so the Conservative government successfully made sure that the housing market in Canada didn't collapse. They had the advantage of they were dealing with just a few banks, and they were able to help those banks continue to make more loans through a period when most of the world was not interested in making residential mortgage loans anymore. So that was the start of the takeoff of the excessive house prices, and it wasn't the start. I shouldn't say it started a few years before that, but that was the accelerant that really got it going. And it worked. But I don't think that option is going to be open to the government this time. And there just doesn't seem to be the ability to make that happen again with house prices dropping the way they are. It's possible. I mean, anything's possible, I guess, if the government really wanted to do it. I know the Chinese government right now is really coping with the bursting of a housing bubble there. And they've tried everything. They almost daily now they make announcements because a lot of the Chinese families have all of their savings in real estate. It's just a tradition there, and they would live in a one place, and then they would have an investment in one of these brand new high-rise apartment building structures where they would buy a unit, and unfortunately the developers defaulted, and now Country Garden China Evergrande was the first one, and then the biggest one was Country Garden. Now there's several of them that have been unable to complete their projects. So the government's tried to get them to finish the projects by giving them, incentives and all that. But it's a pretty severe when the money's not there. You get into issues of if you bail out the developers, do they actually finish the projects, or do they just what do they do with the money? So we had that in the subprime crisis in the U.S. President Obama had a program that was going to help people that were defaulting on their mortgages stay in their homes. Yeah. It makes sense in a way to keep them in their homes and not go through all the foreclosure and the people moving out and all that, and have them as tenants for a while, and then eventually give them the right to maybe get back into the ownership position. And it was shot down because quite a few people felt that it was unfair. If somebody had paid their mortgage, that the taxpayer dollars should go and help somebody who failed to pay their mortgage. So it was a key crisis in the political world in the U.S. Whether people should help these failed mortgage. They certainly helped the banks, but they helped the bank survive, but they couldn't help the individual home borrower, I guess not owner, borrower / defaulted foreclosed mortgage holder. They couldn't help them keep staying in their homes. So it was, but there was a program, but they allocated a bunch of money to it. Very, very little of the money ever got spent. So, that's the kind of thing that the Canadian government, I think, is going to have its hands full of what to do with all these people. Like the immediate thing right now is these condos that are under construction in Toronto. There's a huge number of condos. I think it's in the neighborhood of 80,000 units that are under construction right now.
Mm-hmm.
Total sales annualized this year are going to be about 4,500. So there's also something like 20,000 something units that are for sale right now, brand new condos. I didn't even add up the condos that are pre-sales, but brand new condos sitting 20,000 unsold, another 80,000 or more under construction, and total sales this year are going to be 4,500 at the most. So so there's going to be some developers that need those people to buy those condos when the buildings are finished, and there's going to be a lack of people, and some of the people that put down their down payments are going to be unable to close because the lender will say, well, no, that condo isn't worth that much anymore, it's only worth 3/4 of that, so there's no way we can lend you that money, because people put these deposits down 2 or 3 years ago on the pre-construction financing program. So the people that are defaulting on those pre-construction condo purchases in the next few months, a year or two, they can actually be sued for all the losses that the developer. But are we going to have 20,000 people sued or 30,000 people sued? It seems impossible. That's the kind of thing the government's going to be faced with. And then you've got all the developers that build single family homes, and there's not as many single family homes being built in Toronto and Vancouver where the big markets are, but there's a huge number in Alberta and Edmonton and Calgary, and those development the units under construction are up 47% year over year. So there's a huge potential there, and so the government's going to be they could take the things they could say, well, that's just free market at work. These people made a bad bet, and they should, they need to live with the consequences. Both the lenders, well, all three of them, the lenders, the developers, and the buyers. But will they step in? That's the question. I don't know. The history for the last 30 or 40 years has been that governments tend to step in rather than, in the early 80s, they basically just let it happen. And, there was a few government help programs, but they were pretty minor. And we had that tremendous sell-off, and that's created some great prices in the housing market. Mm-hmm. And then in the 1990s, we had a similar thing where there were some big bankruptcies like Olympia in New York and Toronto and there's some great prices in the 1990s as well, but we haven't had anything since then. So since then, it's been pretty much, the government feels its duty is to avoid people losing money. Even speculators have a right to make money on their speculation, which is crazy, I think, but...
And as you pointed out in your books as well, with CMHC mortgage insurance, like a lot of this is sort of balanced on the back of taxpayers as well. Even in the cases where people put 20% down, I remember in your book, you pointed this out, that they could still, the lender, go and get mortgage insurance for these so-called uninsured loans that they were writing.
Yeah, they did that. And now lately they haven't done as much of that, but when they were allowed to do it in bulk, they did a huge amount of it, which basically is a signal that the mortgage insurance was important to the lender. In other words, they were afraid that there might be some defaults, but also that it was not priced properly. Like if it had been properly priced, the bank would have been smarter maybe to insure it themselves rather than. But there's a wrinkle there, and that's another reason why the household debt was able to grow so quickly beyond the growth in the general economy, was that the banks, as long as they have that insurance on their mortgage, they don't need to keep the capital that the banking system usually requires on loans. So the risk-weighted capital system that was instituted over the last couple of decades, maybe longer, allows the bank to argue that certain loans don't have much risk, and therefore there's zero or very small amount of capital required. So a mortgage that's insured by the government is zero capital requirement, and a regular mortgage where the defaults are really low, the capital requirement might be 8 or 10%. but a business loan is 100% capital required. So risk weighted, 100% risk weighted, which then goes back to the capital formulas that they're required to keep. So there is a real incentive for banks to make housing loans because of those risk weights that are so skewed towards the mortgage market, and that's part of the reason why. And it's a worldwide phenomenon. It isn't just Canada and Australia are the most outrageous examples of this, but it was happening all over the world, and it's just that Canada and Australia have managed to keep it going much longer. And it isn't scientific, but haven't done the studies, but it is interesting to note that both Canada and Australia have 3 or 4 or 5 large banks that are doing mortgage loans, and they're pretty much the only countries in the world that are like that. So maybe there's a correlation there that having a few large banks that are financing these housing bubbles helps keep them going. And obviously the banks in Australia and the banks in Canada are all too big to fail. There's no way that they can be allowed to fail. So that helps as well. And it also gets the government, when you have the government in as your partner in this enterprise, it really helps because people look at the government and they say, well, the government can't let the housing prices fall because they can't let the banks fail, and it's all part of the same big tangled web. And I am surprised. I mean, I have to say, I got concerned about this before 2015 when the first edition of the book came out, and then the second edition came out in 2018. This is now 2024, soon to be 2025. I'm surprised isn't the right word. I would say shocked is a better word, that it has kept the lending government speculator consortium has kept this going this long. It's I guess you could say 2022 was, if that turns out to be the peak, then they kept it going till 2022. So that's pretty amazing, really, when you think about it. And we haven't even talked about money laundering, which is, money laundering is obviously a big factor. TD Bank has gotten more than their wrist slapped. They've gotten a severe hit to the head. But you'll notice, I don't know, some people won't notice this, but you'll notice this probably, that it's always the U.S. regulators are the ones that slap the fines and the big charges against the Canadian banking system. It's never the Canadian regulator, which is interesting, to say the least.
Yeah. Well, and another thing I found really interesting with what happened with TD Bank was that a week or so after, RBC Bank comes out and says, we're not going to pursue any more expansion in the US. And obviously TD Bank was under investigation because they tried to take over, I think it was First Horizon, and then that deal went through. And then I think that's what initiated the investigation, which led to the massive fine that they got. So now RBC is like, oh, we don't want to open that can of worms.
No, the RBC bought a bank called City Savings, I think, in Los Angeles. It was a kind of a boutique bank, and and then in 2023, March 2023, they had that Silicon Valley Bank and two other banks all went under or had to be rescued, and they were large banks. Like they were, Citibank in Los Angeles would have been in that same category if the RBC purchase. The First Horizon's TD purchase that was disallowed. So the government disallowed that. They were going through the due diligence, and then they found out TD had this lax anti-money laundering program, and they found this. So then they turned them down, and that was the big thing. So RBC is realizing that they probably wouldn't get approved for the next purchase anyway. And the thing is that the RBC and TD aren't going to admit this, but it seems pretty obvious to me that the Canadian banks only get to buy the banks that the bigger U.S. banks have turned down the opportunity to buy. Right? So it's not like these are the prime opportunities. The prime opportunities would have been taken already by the U.S. banks, the bigger banks. So the Canadian banks. The other thing that's odd about the Canadian banks expanding in the U.S., I understand why they want to do it because it's sort of like an empire building thing, but they don't have that amazing support from the government in the form of that insurance and the zero risk weight for the mortgage lending. I mean, the return on equity in the Canadian lending division of the Canadian banks is 15% on average. That's their target, and they were well above it. That was their target for the overall bank, but in the Canadian division, it was like 30%. The Canadian banks expanding in the U.S. is questionable anyway because of that. Just isn't as attractive to the Canadian banks because they don't have that wonderful support from the government insurance program for mortgages in Canada, and also the lower risk weight that they can do with Canadian mortgages. So there's a lot more to that whole thing with they use economic models that estimate the risk weight depending on the defaults and the history of defaults. And the history of default in Canada, of course, is lower because of the mortgage insurance. So the expansion in the U.S. is probably over for now, which leaves the Canadian banks in a tough spot, because if the Canadian mortgage growth is going to go to zero or even possibly negative, which it probably never has, except maybe briefly in the 1990s, that's going to be a very difficult situation for the banks, because their shareholders are used to dividend increases every year, right? So it's going to be difficult for them to explain to the shareholders what happened, and they're still traded a premium. I don't know if people are investing in the stock market in the banks, but the Canadian banks still, maybe not TD, but Royal and the other ones still traded a relative premium because they have these higher return on equity numbers. But when you look into it a little deeper, you realize it's really contingent on their ability to continue to make these very attractive mortgage loans. And if that's over, as it would be if the housing bubble is truly bursting this time, then that's going to be a different world for the banks going forward.
Yeah. Do you have any thoughts also on what's happening in the repo market? I'm not sure if you've seen much about it. Ever since they pretty much started cutting rates, the Bank of Canada has had to intervene a few times, and the repo volume has just exploded for the amount traded.
Yeah, I don't fully understand that. That's I've been watching that, and I'm thinking that I've read a couple articles on it that sort of attempted to explain it, but I didn't quite. I don't know quite if they fully explained it, and I didn't quite grasp whether it's just some kind of temporary adjustment or whether it's something more serious than that. One of the things that is happening in the that I do know is odd. Well, two things are odd. One is that long-term interest rates in the U.S. government bonds are rising, and this is unusual given that the economy seems to be slowing and the Fed is cutting rates, and the same in Canada, rates are rising, and that's number one odd thing. And then number two odd thing is gold prices are rising, and that's pretty amazing. So Mohamed Al-Arian, he used to be with PIMCO, and now he's with Allianz, the German insurance company. He's quite famous bond market guy. He's got a story in the Financial Times today of London about it, and he points out how odd it is that this would be happening. So that gold, I don't know if the repo market is trying to tell us that something's odd's happening. It might be, but I think the fact that gold is hitting new highs. Now, gold is hitting record high prices of $2,800, something like that, and close to $3,000 now. But when you go back to the actual peak, adjusted for inflation, it was around $850 in 1980. So if you adjust that for inflation all the way to today, it comes out to about 30. I forget the exact numbers. It starts with three, like 3,300, 3,400, somewhere in there. So so we're a ways away from the all-time adjusted for inflation peak. But I remember the day it hit 850 because of course there was no internet back then, and I was the junior stockbroker in the office, and they wanted somebody to do an interview on the evening news, the CTV evening news. So of course I was the one that said yes, and so I did this interview about the gold price. It turned out to be the exact day the gold price peaked. So if you want to know when the gold price is going to peak, just watch for the interview. So the mainstream media has been talking about crypto and everything else. They haven't really, it's one thing for Bloomberg or the Wall Street Journal to talk about the gold price or Mohamed Al-Arian talking about it, but it's when the evening news like CBS or NBC or CBC actually does a story on it, that's when you got to start thinking, oh, maybe this is getting close to a peak. So we're a ways away from that, because I don't think they certainly haven't phoned me to do an interview anyway.
No, yeah. I saw it hit another all-time high this morning. I saw silver was up like over 3%. I think it's took a whack down now because the markets have sold off a bit, but it's still very, very interesting. And that brings me on to another market, which is one that people watch a lot, is the FX market. And the Canadian dollar is dancing around near the lows of the past couple of years. Do you think the Bank of Canada even looks at the Canadian dollar and thinks, well, this is increasingly weak, so I can't cut as much? Or do you think because inflation just seems to be coming down at such a rate that that's really not going to impact their decision much moving forward?
Well, the rumor is they're going to cut a half a point this week. I guess, is it this week? Yeah.
Yeah,
So,
Wednesday.
So if they did that, they would be making the decision that they don't care if the Canadian dollar goes down to 70 cents or even lower. But they definitely watch it. There's no question. They're watching it all the time, and they're watching the U.S. Bond rates, which are, the U.S. bond rates went down to 3.5%. They're up. Their 10-year bond rate, and they're back up above 4. They're headed back to before they started to come down, they were around 5, and the Canadian bonds have always been a little bit lower. So for people to put their money into the Canadian money market, they have to be worried that the Canadian dollar would drop, because they have to buy Canadian dollars in order to buy Canadian bonds. And so they have to hedge that if they want to. It would just be easier for them just to buy the U.S. government bonds if they wanted something totally safe. So it could very well be that the Bank of Canada sort of abandons the protecting the Canadian dollar from dropping. But it would be pretty hard on the it's going to be pretty hard on the snowbirds and everybody if a Canadian dollar goes much lower, because it's already getting very expensive. For a while there, after 2009, going to Phoenix or Palm Springs or something was for the wealthy Canadians or Florida was pretty attractive, with the dollar being a par. But now it's sort of heading towards 70 cents. It's getting to be very expensive. But I don't think the Bank of Canada, even though they watch it, they maybe that isn't their number one concern. Their number one concern is probably they're worried about a recession. And if they cut by half a point on Wednesday, I think it'll be a sign that the recession is the most important part of their mandate. They've got a mandate that basically is protecting the value of the currency, unlike the U.S., which has a dual mandate, but they don't really have to have the mandate of protecting the Canadian dollar, so they may just decide to abandon that goal.
Yeah, that will be interesting to see what happens, because I've read a few articles on it. Some say that 1% decline in the Canadian dollar impacts inflation like 75 to 1%. I would always see the fluctuations in food as the most thing, because so much of the food is imported from the United States, and those grocery store chains are the first people to adjust their prices, it seems. So
practically everything we buy that's manufactured comes from China, and if the tariffs they're talking about, Canada doesn't want to put tariffs on Chinese imports, but they're already doing it on cars. And if the U.S. does it, then the U.S. is going to force Canada to do it. So we could be looking at a bout of inflation. So the Bank of Canada could drop interest rates by half a point. Inflation could go up because of the dollar and because of tariffs. And they could be looking at a difficult situation there. But on the positive side for inflation, and I've written about this quite a few times, and my weekly note, which people can subscribe to, the biggest component of inflation is the housing shelter. They call it shelter.
Yes.
And it's not house prices. Interesting enough, it's not house prices. And you remember from that chart we looked at the beginning, the shelter index was at the very bottom and the house prices were at the very top. So obviously the shelter index and inflation are not anywhere near the increase in the house price. So the way they do that is a very complicated thing, and we don't have time to go through the whole thing. But it doesn't go up when house prices are going up, but it will start to come down now because of the drop in interest rates, especially. The mortgage interest is a big component of it, and it would start to drop at this point. So that'll help the Bank of Canada. So they may not have as big a surge in inflation as they might have normally, because they're going to get that nice break from dropping shelter costs, which, by the way, is like 30% of the headline CPI, and it's over 40% of the core CPI. So if gasoline prices come down and shelter prices come down, then the food may not be food's the other big one. Food may not be as bad, but so they may take that that gamble. But surely if they certainly if they cut a half a point, that indicates they're worried about a recession, and they should be worried about a recession. Some pretty credible economists are suggesting that Canada and the U.S. both are heading for a recession at this point, and that's normal. I mean, we haven't had a recession for a long time, and unless you count the 2020 recession, which I wouldn't count that. It was so short that I wouldn't count that. That was very unusual. So if you take that out of the equation, we haven't had a real recession for about 14, 15 years. So,
well, Hilliard, I want to thank you so much for coming on. It's been a pleasure. Is there any final words of wisdom that you'd like to give to the audience before you go?
Well, I think that I would just go back to what we talked about at the very first, the housing bubble bursting. Is in the U.S. prices went down. I'm rounding up to 40% was the overall decline, and it took from 2006 to 2010 for prices to bottom, and it took longer than that to break even. So, and the housing bubble in Canada is much bigger. Even though it has been 2 years now since 2022, it looks like that was probably the peak. Prices have not come down enough yet, and we haven't had a long enough period of deflation in housing prices for people to there's no rush to jump back in because of worry about a rebound coming if this truly is the bursting of the bubble. There's lots of time to watch and be greedy, a little bit greedy on just like people are greedy on the upside, be greedy on the downside, and say maybe I can get a real bargain here. The bargains might be surprising.
Yes, yeah, I think they will be. Hilliard, I want to thank you so much for coming on. Please check out Hilliard's book. Please check out Hilliard on Twitter. All the links are in the description of this video. I want to thank you for watching, and I'll see you in the next one.